When I talk about diversification or I think about it for myself or just talk about it in general in the space, I try to get diversified across asset classes, geographies, and operators. That's always been my goal.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in.
All right, welcome back, Freedom Point podcast listeners. Thank you again for jumping into another episode of the Freedom Point. I have quite an amazing guest with me today, a guest that has 3x the amount of LP investments that I personally have. Very excited to have Jeremy Roll on the line with us. Jeremy, welcome to the show.
Thank you. Thanks very much for having me here. Hope this is helpful for everyone who's listening. So thanks for joining us.
Yeah, absolutely. And I'm just going to give a brief bio and then we'll just kind of jump into it. Jeremy started investing in real estate and businesses back in 2002. I left the corporate world back in 2007 to become a full-time passive cash flow investor. He's currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. As a founder and president of Roll Investment Group, Jeremy manages a group of over 1,500 investors who seek passive managed cash flowing investments in real estate and businesses. So Jeremy, really appreciate again you jumping into the episode with us today. Maybe if you can kind of help our listening audience learn a little bit more about your journey, what you're focused on now. Obviously, one of the main things that we'd all really like to know is how you were able to escape the dependence on the W-2 and really move into passive cash flow investments.
Great. And do you want me to jump into that right away or just a quick background first?
Let's go with the background.
Okay, sounds good. So I've been investing in alternative investments, mostly real estate, but other stuff too, as a passive investor, like into syndications, since the beginning of 2002. What prompted that was I was working at Disney headquarters, actually, in Burbank in Los Angeles. And it was a dot-com crash happened in 2001 for anyone who's old enough to remember that. And I was just sick and tired of the stock market going up and down and all the volatility. It's just like I'm a very low risk, more predictable type thinker. And I was actually most concerned about where my retirement account would be in 10 years, 20 years, 30 years with all that lack of predictability. So I ended up looking for different ways to invest, came across the concept of cash flow. And I've been looking for stabilized, more predictable cash flowing type opportunities since then. And that's how I started. So I went through about 5 years from 2002 to 2007 investing when I was still in the corporate world. And then I actually was working for Toyota headquarters also in Los Angeles at my last job, when I had a last straw moment with my manager in the corporate world and I decided to leave. And so that was in 2007. So I've been a full-time passive, limited partner investor for almost 17 years. But I've been doing it, including working. I started back in 2002. So it was about 20. I was actually, I guess it's 22 years ago now this month. And so I've seen, obviously, the last cycle, I've seen a lot of things change. I've seen crowdfunding. I've seen podcasts start. I've seen the iPhone launch, and investing has changed a lot over the years. So we can talk about that too. But if you want, I can jump into getting out of the corporate world if you want.
That's actually the next thing that I'd like to know a little bit more about. And that was, what was that kind of motivation, right, to exit the corporate world? And what were some of those early decisions that you made that allowed you to do that?
Yeah. To be fair, I was not the typical path. I wasn't like, okay, when I speak to some people who call me up and say, hey, I want to get out of the corporate world in 5 years, 10 years, 7 years, whatever the number is. I have a plan. I'm going to invest X amount per year for 10 years. This is the formula. What's the realistic cash flow? And they kind of do it. And I see it. And I love when people get out of the corporate world. It was a fantastic experience for me getting out of the corporate world. For me, it was more about the fact that I wanted to get out of the stock market and deploy all my capital into more predictable cash flow. And my intention was to actually have the W-2 paycheck and the cash flow meant for more predictable retirement account growth. But because of the last straw moment, I decided to leave the corporate world because I had the cash flow built up to live off of. And what allowed me to do that, even though I was a really conservative person, was I was kind of I was at about a 2x cash flow coverage of cash flow to cost of living. And so that's why I was able to take that risk. But really, what pushed me out, which was one of the worst things that happened to me at the time, was this last straw moment in the corporate world. The new manager that had come in ended up being one of the best things. So I'm not a typical path, honestly, and that wasn't my intention to leave the corporate world.
So your motivation to exit the corporate world was maybe non-traditional, but you must have had some sort of a plan once you started to realize that, wow, I can create enough cash flow to supplement or completely replace my active income. So once that happened, what's kind of the rest of the story?
Yeah. So it's funny. I was pretty young when this all happened. So I think I was, so 2007, I was, I'm not doing the math very well in my head. How old was I? I'm probably like 32 or something, right? I was kind of young. Call it between 28 and 35. I'm very sorry. I got to run the math separately here. And so I didn't have this, like, a lot of people I talked to are in their 40s, 50s, and they've been to the corporate world for decades and they're like, I want to get out. I was not at that stage yet. That wasn't my mindset. My mindset was to continue to go up the corporate ladder because I had, building up my resume with these high pedigree Fortune 500 companies. I have a Wharton MBA, like the typical scenario that you're picturing. But I will say that one thing that I had a challenge with when I left the corporate world, even though I had the cash flow, was the fact that a lot of my cash flow was built off of what I call fully amortizing opportunities. So when you think of investing in an apartment building, for example, it's non-amortized. And what I mean by that from an investor perspective is that you expect to get a kind of a lump sum payment at the end when they sell the property because you still have ownership in the property, you're just getting cash flow from the profits, right? I was investing in a lot of alternative things that weren't necessarily like that. I did both, but I had a pretty heavy amount of my cash flow coming in from fully amortized stuff. So, for example, a friend of mine owned a web hosting company at the time. This is before Amazon, AWS, and the cloud and everything else. And he created his own cloud, private cloud for security for companies. And they would use his cloud. And essentially, I leased him some servers. And they were a 3-year term. I was a leasing company, 28% interest rate, 50% cash on cash for 3 years, and a 5% buyout. So what's the problem with that? Well, it's a fantastic return, but the problem with it is that at the end of 3 years, you get a 5% buyout. You're basically almost getting nothing at the end. So if I live off all that money, I had nothing left at the end, which is not good. So my challenge was that I got the 2X because I had a lot of fully amortizing stuff that supercharges your cash flow, right? I talked about that 50% cash on cash return, but I was in danger of eating through it all. And so I had to rotate slowly into more fully amortized stuff and have less of a heavy load, into non-amortized and have less of a heavy load of fully amortized. So I didn't eat through all my capital. So that was my big challenge between, call it 2007, 2012, like about a 5-year period.
Sure. So you had been investing back in 2001 and then also 2006, 7, 8, primarily into Wall Street. And then there was this focus on maybe rolling out or diversifying outside of Wall Street and more into Main Street. Am I correct in
Yes.
saying that?
I rotated from all my stocks and bonds 100% out from 2002 to 2007. It was a 5-year transition that took place for me.
Great. And what was the primary motivation behind that? Was it the roller coaster, the uncertainty, the
Yeah.
system is rigged? Like, what was the motivations?
It was a combination of the volatility that I saw during the dot-com crash that I was not comfortable with. It didn't mesh well with my personality. And it was, the bigger thing was even the lack of predictability of not knowing where my retirement account would be as a result of that volatility in 10, 20, 30 years. I was just trying to set myself up into a more predictable scenario long-term on the retirement side.
That makes sense. Now, I know that you're involved in 60 current opportunities, that span probably a number of different asset classes and maybe a number of different businesses. So maybe kind of talk to us a little bit more about, what the strategy there is. Is the strategy
Yeah.
to diversify with multiple operators, multiple markets, multiple asset classes? Kind of what's your plans there?
Yeah, you hit the nail on the head there. When I talk about diversification, or I think about it for myself, or just talk about it in general in the space, I try to get diversified across asset classes, geographies, and operators. That's always been my goal. I'm a big believer that being diversified across asset classes is very, very important. I know some people, let's say, might be most comfortable with multifamily, easiest to find. There's a lot of them out there; they understand them well. But for me, if you take a look at the whole spectrum of asset classes, and I invest in non-real estate stuff too, but on the real estate side, like a mobile home park may do extremely well during a recession potentially, or better than something else, right? And so they all have their own. And by the way, even with societal trends, which have been even more interesting to talk about, right? I haven't invested in an office building or retail since 2015 that I can remember. And I stopped both of those because of the trend of the internet enabling work from home more. This is way before the pandemic and all that shift. It was just more that technology was enabling more and more people to work from home and also to buy things online. And so there was a lack of predictability 10 years out for me in office and retail back in 2015. I'm still in some of those legacy deals, and I think they're all actually doing well. But the point is that even the diversification of asset classes could be not just from an economic cycle, but just from a consumer preference over time in technology and other things. So that's really critical.
No, that's great. Are there any particular asset classes that you like right now more than others?
Yeah. So yes and no. So what I like for the next cycle, like the next 10 years, my primary like A type asset classes for predictable cash flow will be apartments, mobile home parks, and self storage. The problem is that if you ask me that today, I'm mostly on the sidelines because of timing. But if you ask me what I'm going to focus on once we have a reset, if we have a reset, then that's going to be my focus for predictability of cash flow. Every single other asset class, I will potentially still participate in, but those are the ones that are the most obvious to me for predictable cash flow if I think 10 years ahead.
Now, I think this might probably vary based on the asset class itself, but is there any particular geographies or locations that you tend to focus more on?
Yeah, well, so it's easier for me to answer where I don't invest because that's kind of unanimous across all asset classes. I'll explain in a second, but you are right. Each asset class is different, and I'll give you some examples too that are easy to understand. But so just so you know where I don't invest. So I look for predictability and stability, right? So I won't invest in Los Angeles, San Francisco, and New York, Miami. Those asset prices are too high and they're volatile. So neither of those work for me, right? But I am very open to many different markets because the US is a huge place. And one thing I've learned having come from Canada, I lived half my life in Canada before I moved here, was just how much opportunity there is across so many different places. So I don't like keep a closed mind. I'd rather keep an open mind and almost like exclusionary just in a few geographies. As far as the asset class types, so let me give you some really easy examples. I love mobile home parks. I'll invest in mobile home parks in a tornado type of location, but not in a hurricane type of location. And the reason is that while a tornado could cause very bad destruction, clearly, first of all, it only causes destruction in a very small area. And if it does hit the park you're in, which I've actually been in those parks before, typically FEMA and the government can come help people much more readily because it's a very small population of people they're coming to help. And so often they'll come very quickly in those scenarios and get a lot of positive press and help people. In a hurricane, think of Florida. Think about millions of people being impacted by hurricanes, and you're just one of those mobile home parks, and you have 100 residents amongst millions of people impacted. Are you going to get that government assistance? No, unfortunately, it's not going to come. And if it does, it's going to take a long time to come. So that's why I would avoid, for example, hurricane areas for mobile home parks. Now, self-storage. I'll invest in self-storage in a hurricane area because self-storage typically is very low, doesn't have any windows often, and is usually one story or very low. And really the biggest damage you get from a hurricane is often just the outside air conditioners and stuff, right? And the tenants typically have to have their own insurance for any flooding. And if there's a hurricane, they're kind of stuck having to leave their stuff for a week where they have to pay rent anyway, right? But then there's other areas where it makes less sense to invest in self-storage, possibly from climate, possibly from other reasons. So it really depends on the asset class.
Yeah, with respect to the asset classes that you tend to favor more than others, are you favoring more of a maybe a build to rent type of an opportunity, a new development, or do you tend to focus more on opportunities that are existing where there's a value add element?
Yeah. So actually, what I'll say for build to rent is I have never invested in a development deal in the 22 years I've been investing. So that's just not the right fit for me. And by the way, there's 1,000 ways to invest. None of them are wrong, right? It's whatever is best for the person. So, but I've just never done those. I always look for something that's stabilized and 80 to 100% occupied. And actually, from a value add, may or may not have any value add opportunity. It just depends. If there is going to be value add, I typically do what I call minor to medium, in that there has to be existing cash flow to the level that I want it. And maybe they're turning the units, they're rehabbing units as they turn, not force rehab and not kicking people out, so that it's a slow process and we're not really disrupting the cash flow, for example. I'm just so heavily cash flow focused.
Let's talk about the most important component to investing as a limited partner, and that is the sponsor, right? So,
Yeah.
the jockey riding the horse. So, there's a few T's that I like to personally use when evaluating the sponsor. One of them is the team, two is the track record, three is transparency, four is trust, and then fifth is, we'll call it the tertiary market, right? I had to have a T in there, right? Since geography and location don't start with the letter T. So, what would be maybe some things that you personally do as it relates to evaluating, the sponsor that has a fiduciary responsibility to protect your investment and to ultimately produce the return expectations that they present on their pitch deck?
Yeah, I'm going to throw out. So you covered a lot of really good stuff with the T's. So well done with the T's. And I'm going to throw out a couple things that maybe not everybody thinks about, just to be helpful, I think, because you're covering a good amount of bases here. So number one, mandatory for me is background checks. And I say this because I'm firmly believe in talking to thousands of LPs over the years that the majority of LPs don't run background checks. And I think that is really unfortunate because you spend a little bit of money to save a lot of money, and it's saved me before multiple times, right? So that's number one. By the way, I should also say that I firmly agree with you. The number one thing for me is the team and the sponsor, and the number two thing is the actual property. And the property is a close second, but who you're making a bet on is more important than the property itself, because it's all going to be about how they run the property and how they manage it. One thing I would strongly urge people to consider in track record right now is the fact that we had a record long cycle. And if you're looking at someone's track record is even 10 years old, they only had the wind up to their back until a couple of years ago, a year or two ago, right? So we're recording this in early 24. So the track record is very tricky to really decipher. And I would also say, so you got to be very careful with how you really approach analyzing that. But I would say at this particular timing, we're recording this in early to 2024. One of the most important things I would look at immediately with the team right off the bat is A, are they in any distressed opportunities that may distract them from operating the property you're going to invest in? B, if they are, why they're launching a new fund or why they focused on launching new deals when they have to take care of that distress? Because what I've seen in some cases, and this is just me making an assumption, but what appears to be happening sometimes is that if you can imagine a sponsor who's in great distress across the majority of their deals because of, for example, floating rate bridge loan deals in multifamily, they may not be collecting any fees off those properties, like zero, right? And how do they actually keep the lights on with their team if they're collecting zero fees? They maybe launch a new fund that has an assets under management fee that is going to keep the lights on for all the other funds as well. Right.
Or they buy a new deal with another acquisition fee so that they can collect some cash flow.
Exactly. Same concept. Right. So be very wary of that. So that's why checking to see if someone's in distress right now. There's already been a few foreclosures. If you're going to invest with someone who has been foreclosed at least once, and I saw this in the last downturn, that's why I know this. Most people don't realize or haven't thought about probably the fact that they're going to have a higher interest rate that anybody else who's buying the exact same equivalent property that has not had a foreclosure in the last few years, right? So that means you're taking on a lower return for the exact same amount of risk compared to the next person. So be very careful with that too, because that's going to become more and more of a reality for some operators. And that's something I think people need to really think about at this particular juncture. So those two things are both very critical right now.
Let's give our listening audience some maybe meat around this, and that would be, what would be a couple of questions that a limited partner investor could ask of the operator related to current distress that they might be under, that may not be known to them because they're not currently participating in one of those sponsors' previous deals that currently has distress?
Yeah. So the first thing I would ask, because that's an easy opener, is, have you taken on any floating rate bridge loan deals in the last several years? And if the answer is yes, then the next question is, have you disposed of all of them already, or are you still involved in some of them? And if the answer is I'm still involved in some, let's start to find out how many, right? If there's one, that may be much easier for them to deal with than if there's 5 or 10, because honestly, that exists. Both of those cases exist in reality right now, right? And I would then dig down from there. To be honest with you, if I hear that they're involved in 5 or 10 that maybe have, then you can start to ask about rate caps. You can start to ask when they expire. You can start to ask about when those terms expire and all these more specific questions. Another really good question to ask is debt coverage ratios. Are you involved in any properties that have a debt coverage ratio below 1.2 right now? Because that starts to indicate stress. It's a really simple question to ask. You don't even have to ask if they've done any bridge loan deals, right? And maybe they're in some that aren't bridge loans, but that are fixed rate, but are having issues because rents are coming down in some areas, insurance costs are going up, and some other challenges are happening, right? So, you have to ask these questions, because if you don't, you're not really going to fully understand who you're making a bet on right now and how focused they can be on the property you're about to invest in with them. They're really
Yeah.
critical.
Yeah, absolutely. And that's a great advice. And most of the investment sponsors that I personally have invested with, have not undergone any stress, at least as it relates to, having to raise additional capital from limited partner investors through a capital call, right? What would you maybe give to that listener of this podcast that maybe is being faced with the potential of a capital call on a deal that they're currently in, and how to evaluate whether or not it makes sense to throw good money potentially at a bad deal in order
Yeah.
to keep it alive?
Yeah. So it's actually a good topic. And that's another question. I'm sorry, because I want to go back to the previous. One other important question to ask is, have you raised any preferred equity on any deals in the last, 3 years that you already own that were existing? Right. Because some sponsors are doing that to bring new investors in, but they're literally wiping out the most or all of the equity of the previous common equity investors. And in some cases, it's happening without the common equity investors even knowing. Right. So those are some more important questions. As far as capital call. So I did not invest in any floating rate apartment bridge loan deals. So I am not facing that issue. And so I am really not a good person to answer that question, to give someone, suggestions. What I will say, because I've had this conversation with a lot of people, is at the very least, ask for projections and take a very hard look at them before you decide it makes sense to make a capital call. Because I suspect that if someone's in a market where rents are reducing right now, they're probably going to be underwritten as flat. But do you agree with that? Are they going to be flat, or are they going to go down? Right. And by the way, if they go down, that's going to impact your net operating income. That's going to impact a whole cascade of things. Right. It's absolutely imperative that before you make a capital call, you understand whether or not you agree with the projections that are the assumptions that are being used to use your money to deploy it. Because someone may be putting a band-aid on one cut, but there's another cut on the other arm that they're not talking about, or that's about to happen. They probably know is high probability, right? And they may have to take more capital for the second cut, and then maybe a third one, right? And so you really have to dig in. Like, just doing blindly going into capital calls right now is really the exact wrong move to make, unless you make a decision that you're not going to go into capital call at all, which could be your approach, and that's okay too.
Let's talk about those bridge loans, those floaters, which is one of the major catalysts why some operators are experiencing distress today in the marketplace. From what I'm hearing you say, is floating rate bridge loans are not something that you typically like when it comes to evaluating an opportunity. My question, however, for you is this, and that is, if the operator's business plan is to acquire an asset with a moderate to heavy value add with the intention of selling that property within, say, 2 to 5 or 3 to 5 years,
Mm-hmm.
if they sell the property before the fixed rate loan were to come due, they get hit with yield maintenance and defeasance, right? So it's
Yes.
either they pay for a rate cap on the front end with a floater, or they end up potentially paying that yield maintenance or defeasance, at the end. So what would you say in that type of a scenario? Am I helping, maybe helping this cause and case as it relates to not necessarily not doing a deal that has a floating rate bridge loan?
Yeah. So the first thing I'll say is that, look, if you get certain rate caps and everything, it can almost become the equivalent of a fixed rate with benefit of potential rate reduction. So it's not necessarily a bad thing. But I'd also argue that you could take a 5-year fixed rate loan and just sell in years 4 and 5, right? So just eliminate that uncertainty or lack of predictability. And of course, again, everyone's going to have a different opinion about that. But let's just rewind a second. Okay. So if you take a look at 2020, 2021, 2022, if you ask me, Jeremy, why didn't you invest in any multifamily bridge loan floating rate deals, right? And my answer is twofold. One is because I don't invest in floating rate loans. Okay, so that's just number one, because it has less predictability than fixed rate loans. And I'm not just saying this in retrospect. It's not what I do. I don't think I've ever done that, right? Number two is that the one thing I definitely wouldn't do is invest in a value add deal at the end of a cycle. Now, we already knew that we are in a record long cycle as of 2020 or 21. I forget the exact timing, right? So again, this isn't like, oh, it's easy for me to say in retrospect. No, at the time, we were in a record long cycle. If you assume cycles never exist, which I've actually had to say to people on podcasts before, then yeah, go ahead and do it. But if you assume cycles exist, the most dangerous time to invest in a value add opportunity is at the end of a cycle. And the best time to invest is at the beginning of a cycle. Okay. Now, we haven't had a cycle reset yet. And the reason why it's best to invest at the beginning of the cycle is because you have the wind at your back, rents are going to slowly go up, the economy is going to grow, and things are going to help you to get a better valuation. Investing at the end of a cycle could hurt you to get a lower valuation. That's what we're seeing right now as things are resetting, right? Now, um, the irony, of course, is that if you're an investor, what you're presented with is actually most commonly the most value add at the end of a cycle and the least value add at the beginning of a cycle. And the reason why is because buildings get so expensive when stuff's bid up towards the end of a cycle that value add is the only way to actually substantiate returns and pro formas for investors that actually will meet the requirements to attract them from a marketing and a return perspective. But at the beginning of a cycle, when prices adjust, it's actually investors will be happy to have cash flow, less volatility because we just went through a whole reset, and the prices will adjust to make that possible, right? And so that's the irony is that you have the least amount of value add at the best time to do it, and the most amount of value add at the worst time to do it. And that is why, as an investor, it's not just good enough to get these opportunities and say which one makes sense today for me. It's about where are we in the economic cycle and the real estate cycle, and does this make sense today? So just an important point for everyone to keep in mind.
Yeah, no, I appreciate that. That's great. And I've been taking some good notes over here. I'd like to talk a little bit more about, kind of one of the key metrics that most investors look at when they're evaluating one deal from another, and that is the IRR. Okay. And the reason why I want to highlight the IRR is I want to get your perspective on, that IRR is largely based upon some assumptions that the operator is making. What are maybe two or three different assumptions that the limited partner investor can really challenge in terms of the underwriting process? What are a couple of things that they should really be on the lookout for in terms of pushing back on the operator as it relates to their assumptions?
Yes, absolutely. So that's an easy one to understand, especially at this timing. But I just start off by saying something else, which is I don't actually look at IRR myself. I look at cash on cash and total annualized return. And the reason is because I'm a cash flow investor. And so that, by the way, most people look at IRR and not ROI and cash on cash. So I am an anomaly with that. Okay, but I just want to give everybody that disclaimer. I don't look at IRR because to me, when I get the right cash on cash and it's a typical stabilized deal, it lines up to a specific IRR anyway. If there are conservative assumptions. Okay, so I think some of the easy ones to look at are definitely the exit cap rate, which is the multiple someone's going to pay for that property in the future. That is an assumption in the future and needs to be looked at and reviewed very carefully. The easy ones today, though, are rent increase assumptions and vacancy assumptions, right? So if you think we're going to have a recession in the next 12 to 24 months or sooner, like I do, you should assume vacancy is going to go up, rents are going to come down. That's what happens in a recession across most, if not all, asset classes, right? Is that baked in there or not? Do you agree with that? You want to look at the expenses, and if you want to determine if an operator is really detailed, I've seen some pro formas with expenses where everything is just across the board a 3% inflation increase each year, and that's fine, I guess. But then you have the operator who actually broke out health insurance costs and other general insurance costs and actually apply different inflation increases to actually each line to be more realistic. That's a more detailed operator, right? When you, in terms of reading between the lines, for example. So you're going to want to look at those and evaluate those and see if you agree with those as well. You absolutely want to take a look at a total expense ratio and see if you agree with that, because one way you can jack up profitability and assumptions is to reduce the expense ratio overall. And if you're below a normal expense ratio, you're going to have more profitability, which is going to make your IRR go up. Right. And you have to break it down into the line items, but ultimately you can just take a quick glance at the expense ratio percentage and see if you agree with it or not for that specific asset class in that location, that climate, which does change it. And so those are just a few things you can do, on the IRR side.
As it relates to investing in multifamily and other asset classes, what's one big lesson that Jeremy has learned in his investment journey that you would encourage our listening audience to be on the lookout for?
Yeah, it's something I learned pretty early on coming from the corporate world, but it's even more applicable today. When I first started, I'm working at like Disney headquarters and I'm putting together these polished presentations for executives and everything else. And everything has to be polished, right? And it had to be perfect if it could be. And so I started looking at investment summaries, overviews, business plans. And it didn't look like it was very amateurish to me. I just immediately passed on. But what I've come to learn is that I'd rather invest with the operator with the best execution and the worst documents, so to speak, than the operator with the best documents and the worst execution. And what I mean by that is marketing, right? nice looking marketing documents does not necessarily mean you're going to get fantastic execution on the ground. And I don't think a lot of people think about that point, but I've definitely opened up my mind over the years to that, because I think that was a mistake I made when I first started.
Sure. Other than continuing to, double and triple down, on your investment strategy and continue to invest in Main Street, whether that be in asset classes or other businesses, what's really next on Jeremy Roll's, plans for the rest of 2024 and beyond?
Yeah, look, 2024 for me is a very big side on the sidelines year. I still believe that there's a high probability of a recession. And so I am just waiting to see what happens. If we have some markets already have declining rents in certain asset classes, and that means if I invest in a building today, it might be worth less in a year, or it certainly could have lower profitability in a year, which is not good for someone like me who is not really a major value add investor. And so right now, the sidelines is the best place for me to be to see if we're going to have a recession, to see what happens with the elections. And also, it's very possible there may be more money printing this year, which is what happened a ton in the background last year with a lot of people not realizing a lot of stimulus was put forth on the government side, not the Fed side. And I suspect they may continue, and that could delay the recession again until next year. So we'll see. But
Sure.
it's a big waiting game for me. I just want to remind everybody, the stock market moves quickly, and you want to be early rather than late. The real estate is the exact opposite. It moves slowly. I'd rather be late than early. And that's the stance I'm taking in 2024.
Yeah, absolutely. Well, if there's continued money printing, I know one thing is true about real estate, and it can typically tend to be a hedge, against some of those inflationary, times. So really appreciate that. Jeremy, is there one particular book or podcast that you typically like to recommend to, other investors that are looking to, either get started or continue, their investing journey?
Yeah, so I'll just throw out a couple books. They're both related. I strongly recommend if you're relatively new or not, and you haven't read Rich Dad Poor Dad by Robert Kiyosaki and Cash Flow Quadrant by Robert Kiyosaki, those two in that order. There's a little repetition between the two, but still worth reading both. Strongly recommend both just from a mindset perspective. It's really can be eye opening to someone, especially if you're in the corporate world right now.
Yeah, absolutely. And to further that, and I probably mentioned this before on a podcast, but Cash Flow for Kids is an excellent Robert Kiyosaki board game. So if you have, children anywhere from maybe the ages of, 8+, that's an excellent board game. I know my 4 children have really enjoyed playing that board game, over the last couple of years since we've owned that. So appreciate that.
Yeah, let me just throw something else on there. So I graduated mine from Cash Flow for Kids to Cash Flow 101, which is the first adult board game. And I really could not agree with you more on that recommendation. But just know, when I bought Cash Flow for Kids, it was no longer being produced. I'm not sure if that's still the case. So you may have to go on eBay and buy one, and it's very expensive. I bought one for like $120 probably 6 years ago, right? And it was mint, but it could be a lot of money, but it's really worthwhile.
So your story, my story is exactly the same. I did also have a hard time finding Cash Flow for Kids, and I know I paid at least $120 for that board game, if not more.
Yeah, it's worth it though. It's very much worth it.
Yeah, absolutely. 100%. So what would be, maybe 1 or 2 different ways that our listening audience can connect with you to learn more about what Jeremy's up to?
Yeah. There's no way to follow me. I'm not on any social media. So there's really no good answer for that. If you do want to reach out to me, the best way is through my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. If there's any way I can help anybody, don't hesitate to reach out.
Yeah, well, I appreciate that very much. And obviously really appreciate you being on the show today as well.
Yeah, absolutely. No, thank you for having me here. For those who've stuck on here the whole time, appreciate you having you. And hopefully this was helpful for you.
Yeah, absolutely. And appreciate the tremendous value that you've provided us today. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.